global economy is presently dominated by four themes: the Chinese slowdown, the impending rate hike by the US Federal Reserve, the large-scale slump in global commodity prices, especially oil, and the continued sluggishness in the economic recovery.
Against this backdrop of negative to modest private growth rates for larger economic powerhouses and major emerging developed economies, India's economy is poised to grow 7.6 with potential growth rate even higher than this. The primary challenge for India is to sustain this growth while spreading its benefit more widely. This requires continuous effort, as international experience shows that growth slows down unless reforms are pushed through when growth is high. Major obstacles to India's growth rate are infrastructure shortage, large fiscal deficit, unreformed financial sector. So, this topic for today is very pertinent to understanding how India is growing and what steps and what are the obstacles that we are facing in India's growth.
Hindrances that will be affected in the Indian growth are the tax structure, interest rate, and the NPA.
Well, to me, India has been going through stagflation for quite a long period of time in the past. This, coupled with India's continuous attempts to finance the high current account deficits with the capital inflows, has resulted in a slow and sluggish growth structure in India.
Public investment will be the main driver of growth, as the private sector's ability to leverage balance sheets for infrastructure projects is either already overextended or has very little headroom.
Private investment, from a macroeconomic standpoint, is a purchase of a capital asset that is expected to produce income, appreciate in value, or both generate income and appreciate in value. Investment is not the same as savings in the world of macroeconomics. If you are not purchasing a capital asset that is used to generate income, such as a machine, or with the expectation that it will appreciate in value, like a house, then you are saving, not investing.
The financial sector in India had an overall growth of 15%, which has exhibited stability over the last few years.
The major step towards opening up the financial market further was the nullification of the regulations restricting the growth in the financial sector. To maintain such a growth for the long term, the inflation has to come down further.
Given the fiscal constraints that leave little room for expanding public investment at the scale required, public-private partnership has emerged as the principal vehicle for attracting private investment in infrastructure.
The Planning Commission has identified to invest an amount of $1 trillion in the infrastructure development in the coming 5 years. The ability to meet this target will critically depend on two factors. The first is the ability to successfully increase the dependence on the bond market, and the second is the reduction of the pressure on interest rates of bank lending.